We want to see how we can use the forward rate agreements. When you check on the required part, we are told to recommend a hedging strategy for the Kenyan shillings 27 million investment. This is an investment based on the hedging choices which Treasury staff are considering, and if interest rates increased by 1.1% or decreased by 0.6%, you are supposed to support your answer with appropriate calculations. Okay, so when you read now, you look at, now we have looked at the required part. Okay, you have different options. At the end of it all, you have different hedging strategies. Okay, at the end of it all, you want to recommend the best strategy or the best option. Okay, so you need to read the case study and see the strategy is given. Okay, or the option is given. Okay, so they are telling us that I will first focus on the forward, the information talking about forward. But when it comes to forward, maybe before we even talk about the calculation number, when it comes to forward rate agreements, there are some things you need to really understand. You need to really understand. Okay. First of all, for all these questions, it's good to know whether you are an investor. It's good for these questions related to interest rate management. It's good to know whether you are an investor or a borrower. It's good to know investing or borrowing. That one is very, very key. If you are a borrower, your worry is about an increase in interest rate. Then if you are an investor, your worry is about a decrease in a fall in the interest rate. Because you as an investor, you want to maximize the return, the profits, okay? But for you as a borrower, you want to minimize on your interest expenses. So if it's the forward rate agreements, as I said, here you're entering, you want to fix the rate. Okay? You can agree that the rate, I want the rate to be at let's say at 5%. Maybe you agree with the bank that the central bank rate to be the rate to be at you agree that the rate, you agree with the bank that the rate should be 5. If you find that at that time when the transaction is happening, the rate is at 6, at 6, you as an investor, you will be asking yourself, you as an investor, are you benefiting or you're losing? Of course, you as an investor, if the rate increases, it looks like you're benefiting, isn't it, colleagues? You agree that the rate should be 5, but at the time of the transaction, the rate is 6%. In this situation, it looks like you as an investor, you would be benefiting. And in a situation where you are benefiting, you agreed with the bank that the rate should be 5. Then at the time, the rate is 6. Then every time you find that you're benefiting, you'll find that you're the one to compensate. Okay, let's see. Now, as you answered, first of all, you needed to know which forward rate agreement rates are you going to base on? Are you going to base on, are you seeing the question paper?
Yes.
Okay. These are rates. So the question is, are you going to enter into an agreement with the banker to fix the rate at this or to be at this. Okay, so you need to know which rate is applicable to the question you're handling. Okay, and how do you know that? How do you know that? To know that, what you're going to do is to look at, you need to know what is the date now, what you look at now, okay? Now is which date? It's the 1st October, 1st October, isn't it? 2020, that is 1st October 2020 what? 1st October 2023. Okay, you look at it at now, then what is the, when are you expecting to receive this money? When are you expecting to receive this money? You expect to receive this money, you expect
January.
on the 31st January 2024. That's when you expect to receive the money. That is like the investment date, 31st January 2024. Okay. Then you expect to you are going to invest for how long? Let me see from our question. Now you have received the money. You have received the money on 31st January 2024. And you want this money to be invested locally in Kenya, most probably for what? For 5 months until 30th June 2024. So you want to invest this money for a period of 5 years, rather 5 months. Sorry. Yes, sorry. That is until if you add that is until which date? Until okay, 30th June 2020, 30th June, 30th June. That is 2024. So from now to January, from 1st October to 31st January, how many months? Count from now to the time you expect to receive money. How many months?
4 months. There are 4 months.
You need to use your fingers. Count very well. October is inclusive. So you start from October, November, December, then also January is inclusive. Okay, so these are 4 months. Then from 31st January to 30th June, how many months?
5 months.
5 months.
These are 5. So to know the category you're going to use, or to know the forward rate agreement rate, you're going to look at this, the starting point, that is 4. Okay. Then this one is going to go up to what? You get the end period. This is the start period, then the end period. You get the 4, this 4 plus 5. And you'll be in a position to get 9. Oh, you'll be in a position to get 9. Okay. Are we together? So the start is 4, then the end point is 9. So once you have this, then it gives you a better position to know the forward rate agreement you're going to use. So here we are using which forward rate agreement? We are using which forward rate agreement? We are using which rate? We are using 5.0, 5.02. Okay, that's what we are using. So that will be, so it means that here our forward rate agreement that we must rely on is this one. So once you understand, once you know your forward rate agreement to use, then you can say, maybe you can say that as your starting point, you can say You can say that this company, do we know the name of the company? This company, okay, this company shall use the forward rate agreement of 5.02%. And this is based on this category 4 to 9. Since the investment will take place in 4 months from now. That is 4 months time. And that's when, in 4 months time, that's when you want to invest. But you're going to invest for how long? For a period of 5 months. You want to invest in 4 months, in 4 months time, but for a period of how many months? Those are 5 months. So after doing this, then you go back to your question here. Okay, scenario where our interest rate has increased. If the interest rate increases by 1.1%, if the interest rate increased by 1.1, what? Okay, let me see if the interest rate increased by, let me see, initially what was the rate?
It is 4.2.
Yeah, currently what is the rate? Yeah, it is 4.2. Yeah, currently it is 4.2. So you get that 4.2, you increase it by you get that 4.2, you increase it by 1.1%. What do you get? You get 5 point, is it 5.3? We are getting it from where? From that 4.2 plus the increase 1.1%. Okay, so in a scenario where the interest rate increases by 1.1, what will happen? You as an investor, you're going to invest and you expect obviously to earn. If you invest, you expect to earn income. Oh? So you will have what we call, how much will you get? Actual interest income or actual investment income. Actual interest income will be equal to, remember we are told that from our question, we are told that if you're going to invest at a central bank base rate less 30 basis points. So it means that when you invest, you expect a return, the actual return to be the central bank base rate, then minus the 30 basis point. Okay, your return on investment will be the central bank base rate, let's say 30 points. What do you get? That is 0. So that is 5.3, the one we have up, because now the central bank rate has increased to 5.3. Then you remove that basis point. Remember, we said that to convert that basis point into percentage, you get 30 divided by 100. What do you get? You get 0. Is it 0.3?
Yes, it is
0.3%. So this is the actual return on investment. This is the actual return on investment. Then the answer you get, of course, here the answer you get, you multiply by the amount of money you invested. Okay, how much did you invest? That is 27 million. You invested 27 million. For how long? For how long? That is from 31st January to 30th June. So you invested this money for only 5 months. So it is 5 out of 2. So how much do you get? How much do you get? Put for some speed. Colleagues, let's put for some speed. How much are you getting?
I'm getting 56.25.
You're getting 56.
56.25.
0.25. Maybe you're keeping your answers in million. All of you confirm?
0.5625.
Let's put the figures. Let's not keep our answers in million. Let's see. Let's put our answers in. Just on your calculator, put six zeros and tell me the right figure. Please tell me the right figure.
562,500.
562,500. You keep quiet, we waste time on this. As an investor, you always expect to maximize profit, isn't it, or return? So you enter into an agreement, say that, to avoid issues, let me enter into an agreement saying that the rate, in the future rate, let the rate be this. It should not fall below this, you as an investor. It should, because you as an investor, your worry is about the rate falling or decreasing. So you enter in an agreement saying that the rate should not fall below this or should not decrease below this. Now, in a situation, now you have entered into an agreement like this. Now, in a situation where we find that now the rate has increased, we'll be asking ourselves who should compensate. Okay? Who should compensate? That's where this rate is going to come now. And the one to compensate, we are going to be asking ourselves, that person is going to compensate at how much? So that's where we will use this rate. Okay? So what does this one mean? It means that you will be asking yourself in this arrangement, who is benefiting? The one benefiting is the one to compensate. If the rate increases, if the rate increases to 5.3, who is benefiting? Who is benefiting?
Is the investor. The rate increase, the investor gains more.
Yeah, the investor gains more. So here, it's like the investor is the one benefiting, okay? And the one benefiting should be the one to compensate. So here you will come and say, out of this money, you as an investor compensate. So you're going to raise that compensation. You're paying to the bank because it's you. You entered into an agreement saying that the rate should not go above this. So in a situation where the rate has increased, then you must compensate the bank. Payment to the bank or compensation to the bank. if you realize that it's the banker benefiting, maybe the rate has decreased below this, then it's the banker to compensate. It's the bank to compensate. And how much? Here, now if it's you compensating, you're compensating at how much? You're getting, you'll simply get the increase now, the rate now, that is 5.3, minus what you agreed, what the contract say, that is 5.002%. Then
So you leave out, you ignore that 0.3 basis.
Yeah, the 0.3 basis just affects your actual investment, because the question said if you invest, the actual rate will be the central bank rate less the basis point. It does not affect your arrangement. It only affects what you invested. It does not affect this. Is it clear?
Yes.
So you might buy by what?
27.
By 27
million.
5 out of well, how much do you get? How much do you get? So what we put here, colleagues, what we put here, you consider the one benefiting. If it's the banker benefiting, the banker must compensate. And if it's the banker compensating, it means that the income is increasing. It means that here you add. It means that your income will be increasing. But if you are the one making payment, you're reducing the income. Okay, how much do you get?
31,500.
So here I put 31,500. Okay, so finally, what is the net receipt? The net income or the net receipt?
531,000.
You get this plus, for you, you'll be subtracting. Okay, so that's what I have. Then finally, the final answer should be, you're going to get the effective interest rate. How do you get this effective interest rate? Because this effective interest rate will help you to know which strategy is better. Okay, so to get this interest rate,
Net receipt over the investment amount times the reciprocal.
investment amount. If you're dealing with the loan, you say over the loan amount. Then times what?
The reciprocal of that.
Times 12 out of what?
5.
12 out of 5. This is what you should do, at least try to. You do the reciprocal of what you have here up. How much do you get? If you substitute in your formula. Substitute. Here you're getting this. The answer you get, you multiply by 100. This is over. What was our investment amount? That is 27 million. Then we multiply by 12 over 5.
I'm getting 4.6.
What rate do you get? It's a rate, it's not amount, it's a rate here.
I'm getting 4.6%.
4.6%. Okay, so you're done with the situation where the rate has increased. Now, in a situation where there is a decrease in the rate. If the rate decreases by 0. What? It was 0. What? 0 point. In the question, it was 0. What? If the rate decreases by 0. Let me see, by 0.
0.6.
0.6. What will be the new rate from 4.2? From 4.2, you will go to what? If the rate decreases by 0.6%, you have your central bank rate at what? You get 4.2. And it is 4.2. Yeah, 4.2 minus
3.1.
3.1%. That is from 4.2. Initially, currently the rate is 4.2 currently, and we are saying that
No, it is 3.6, not 3.1.
Yeah, it's 3.6.
Okay, this is 3.6.
Yes.
Okay. That's how we are getting 3.6 from 4.2. 4.2 is given in the question. I hope all of you saw where that 4.2 is. It's given currently the rate is this, the central bank rate is 4.2. Now in a scenario where that 4.2 has decreased by 0.6, then the new central bank rate will be 3.6. Okay. Now you do you the actual. You've just followed.
But Abel,
Yes, please.
how come in the Abel, my question is, how come in the first scenario, the 4.2, we increased it by 1.1? So I was thinking in this, even when we are going to reduce the 4.2 by 1.1, why increase it by 0.6?
It is in the question.
In the question.
That's what the question says, please.
Read the question.
Like you see, even here, they are telling you that, however, the Treasury staff have seen prediction that the central banker.
Yeah, I've seen. I thought it was increasing or decreasing using the same rate. Okay, I have seen it. Thank you.
Okay. Okay, so you follow same steps. Follow same steps. Here you get the actual interest income, but here you're using what? Remember, as you get your actual interest income, it must be affected by the basis point, because you're investing at a central bank rate less the 30 basis point. So the central bank rate now, your central bank rate is 3.6. Then you remove the basis point, which is 0.3%, for you to know the actual income you're going to get. So times the amount of money you invested, then times for how long? 5 out of 12. What do you get? Put some speedy colleagues, otherwise you will not do rote. How much are you getting?
$371,250.
The situation where you have a question, please don't keep quiet. It's a discussion. That is how much? 3? You're getting how much?
$371,250.
371,250. All of you, that's what you have? Okay, so here, who is compensating? Who should compensate? The investor or the bank?
The bank is compensating the investor.
The bank should compensate. Remember, you are the investor. You are the investor. Your worry is you don't want the rate to decrease. Because if that rate decreases, you're going to lose as an investor. So you enter into an agreement with the bank saying that, okay, in our time, in 5 months' time, the rate should remain like this. So now the rate has decreased to what? 3.6%. So in that situation, the bank will compensate. So you just need to know who is compensating. The one who is benefiting should compensate. So if it's the banker compensating, are you going to subtract or you're going to add?
We are going to add.
It means that here we are going to add. Here it's receipt from or compensation from bank. Compensation from bank. And what is that? You get the CBR rate now, that is 3.6. Okay. Let me just say 5.02% minus 3. I'm doing this to avoid the negative, to avoid the negative. 5.02% minus 3.6%. That's what the banker should compensate. Then times 227 million. Then times 5 out of. Colleagues, if you're there and you're not understanding, you should at least ask. You can ask even in your vernacular so that your local language, so that another person can translate. But at least understand this thing.
I think that the total is 405,000.
405.
5,000.
1,000.
It's 405,000. 5, not 6.
405,000. Are you
As I
sure?
got a different figure. Let me confirm.
No, that figure is very low.
But
Colleagues?
me, I also have a different one.
What do you have? Colleagues, you may be knowing things, but the calculator.
159.
Pardon?
159,750.
159.
750.
That's what you have, others? Others, that's what you have?
Correct the figure, it is 159, not 157.
159.
9. Yes.
The answer you get here should be the same as this. This one, let me see. This plus this. Okay, here you are correct. Okay. Why the answer is the same? Because we are saying no one should benefit from this arrangement. No one should benefit from this arrangement. Because you're entering into this agreement to avoid what? To avoid fluctuation in the interest rate. So what I should pay what I expect to receive in 5 months should be like this, without an increase or a decrease. I expect to receive this money without a decrease, whether the rate increases or decreases, may I expect to receive this. That's why you see you have the same answer. You have the same answer. Because of the forward rate agreement. It has helped you to make sure that Even if the interest rate increases or decreases, you can remain in the same position. Okay? And that's all. Just here, you go ahead and compute the effective rate, which is the same. Is what? The effective rate is this one. Okay. That's all about forward rate agreement. That's all about forward rate agreement. Just you need to understand, in a situation where you're dealing with a loan, in a situation where you're dealing with a loan, this is an investment. In a situation where you're dealing with a loan, here you put actual interest cost. Actual interest cost. Because you'll be paying the interest on loan. So that's the cost to you. So here you put actual interest cost. Okay? Then you ask yourself, are you going to add to who is benefiting? The one benefiting should compensate. That's just the logic. So the one who compensating will give you the picture. Are you adding? Are you subtracting? If you're the one who compensating, then what are you going to add? If you're dealing with now, if you're dealing with a loan and you're the one to compensate, it means that to your side it is it will be increasing your interest cost. If it's a banker compensating, then your actual interest cost will be reducing. Okay. To understand, you can also check these past paper questions. These past paper questions. These ones. Like June, let's open. Can we open, or we go to another strategy? Can we open June and we go through like June CPA paper, or we go to another?
Yes, we open.
Okay.
Let's look at June.
Okay. Let me hope you have a question, bank. Let me try to open here. Advanced FM. Question 2. We have 6 marks here to clear. You read it through. They are telling us that I don't have business with first paragraph. Okay, assuming today is 20th January. This one matters a lot. Assuming today is 20th January. Over the next 2 months, CFL expects to export. They expect to export. Okay, they expect to export a flowers worth 11 million euros to LCL. That is the first transaction. Over the same period, CFL expects to import. In the same period, they expect to import inputs worth 14 million euros. Okay. Now, when in a scenario where you meet such kind of statements, then you need to net off, because this is happening in the same time. You need to net off and see, are you remaining in the payment position, or you're the one to receive? Remember, here you're exporting and at the same time importing in the same currency. So you net off. Okay. So if we net off, we remain with how much? This is June.
3 million.
June 2022.
With 3 million.
Question 2. Question 2. So we have the export. We have the export or the receipt. The receipt from export. receipt, that is from your export, and you have an import. This is the payment where you have where in a situation where you're importing, that means that you're going to make a payment. Okay, the receipt is of how much? You are exporting goods worth what? 11? Is it 11 million? 11 million. Then you're importing goods worth
14 million.
10 million.
14 million. So net off and get the answer. Okay.
Payment is a payment of 3 million.
14 million. So here you have a net. You have a net payment of 3 million. So here you're dealing with a payment, not a receipt. Okay. Let's see. Let's continue and see. Okay, all the transactions are on the cash basis, and the CFL wishes to manage the implicit cash deficit using a 3-month concessional loan. So here it's a borrowing. You want to borrow that deficit of 3 million. You want to borrow a loan and make that payment, which it has negotiated with its bankers, okay, at a rate of 7%. Okay. SBL's concessional lending loan is set at par with central bank rate, that is CBR, which players in the local financial market use as the benchmark rate. Okay, the CBR rate is expected to fluctuate. By 2%. Okay, over the next 3 months, while the yield curve is expected to remain unchanged over the same period. Okay, CFL's managing director has directed the head of treasury to institute a mechanism of managing the interest rate movements that will result from the expected CBR rate fluctuations. The head of treasury has requested SBL to propose a financial products which can be used for this purpose. As such, SBL has proposed 2 products. Okay, here now you're negotiating with the bank. One, we have 2 to 5 forward rate agreement, which is given at this. Okay, and okay, that is 7% to 60%. Okay, and interest rate features for us now, we don't want to deal with the interest rate features. We are still handling the forward rate agreement. So in a situation where we are given a different category or different forward rate agreements, you need to know which one to use. Looking at now, using the same idea here, the one we used here. Now is what? Now is which date? Because in some questions you'll find that you're given different rates. You have 2 to 5, you have 3 to, let's say 3 to 5 to 8, depending. You need to know which one to use. So you look at now. Now today is the 20th January. 20th January. 20th January. 20th January. And you expect the transaction is going to happen when? When are you making the payment or when is this transaction happening? Over the next 2 months. Over the next 2 months. So you add next 2 months, that will be, if we add the next 2 months, that will be Feb, March. Let me just say that 30th March, okay, or 31st March, okay. Okay, then you expect on this 31st March, you want to borrow. You want to borrow using a 3-month concession. So it means that here you are going to borrow for and make a payment in 3 months. So here you add, if you add 3 months, it means that the closing or the end date will be April, May, June. Okay, let me say 30th June. So here we have 2, then here we have 3. Okay. But in a short, what I'm trying to explain is that the start date, the start period is 2, then the end period is what? You get this 2 plus 3, which gives you 5. So if you have different rates, then you must stick to where you have 2 to 5 as your rate. So here our forward rate agreement is what? Our forward rate agreement is what? The one given 72726. Okay. Okay, so let's apply the same knowledge from here. Because they told you in the question, they told you that this rate is expected. Currently the rate is 7. Currently the rate is 7. The CBR rate is 7. But they are telling you that it is expected to fluctuate by 2%. So you don't know whether this 2% will be an increase or a decrease. So in a question, when you're handling a question like this, then you assume you will be having 2 options. In a situation where the rate has increased by 2%, and in a situation where the rate has decreased by 2%, because you don't know which kind of movement. Okay, that's why you need to look at 2 options. Okay, so you will say if the rate using the same, I don't want to repeat this statement. Okay? If the interest rate fluctuate assuming the fluctuation of what? Assuming the fluctuation of CBR upwards. Don't use another word, upwards. Or if the rate increase by 2%. If the interest rate increase, or if that CBR rate increase by 2%, that will be from 7% to, initially we had 7%, so it is from 7% to at what? This one will be to 9%. Okay. If the rate we are dealing with 7%. Okay. If the rate increase by 2%, it will be 9%. What does that one mean? Here you are making a payment. So what will be the actual interest cost? The actual interest cost. Do you have basis point here? Do you have basis point here? No. So you simply get, we don't have a basis point. So your rate will not be affected. You simply get the rate, the current rate now, which is 9%, times you're going to make a payment of how much? 3 million. Then times in a period of how long? How many months? 3 out of 12. How much are you getting as your interest cost? Then we ask ourselves, who is compensating from this transaction? Who is going to compensate? Are you the one compensating as the borrower, or the banker is the one compensating? I want to hear from you. Remember, here we are dealing with a payment. This is a borrowing. This is borrowing. Borrowing. You as a borrower. You as a borrower. You enter into this transaction. You enter into this transaction to mitigate the future, to mitigate the increase in what? The increase in the interest rate. You as a borrower, you enter into this agreement to mitigate or to minimize an increase in what? Increase in interest rate. Okay, so you tell the bank that the rate should not increase beyond this what? Beyond this percentage. You agree with the banker that the rate should not, you are agreeing with the banker that the rate should not exceed what? Should not exceed 7.
7.
Okay, so that's where this 7 and 6 will come in. If you are a borrower, then you agree that the rate should not exceed 7. If you are an investor, you agree that the rate should not go below 6%. If you are a borrower, the rate should not go beyond what? Beyond 7. Okay. So now in a situation, now we have fixed that the rate should not go beyond what? 7%. In a situation where the rate has increased, who should compensate? Who is benefiting actually?
The
benefits.
The bank is benefiting. So the banker must do what? The banker must.
The borrowing.
Yeah, the borrower.
You as a borrower, you pay. If you are an investor, you receive. But here it's the borrower. You, the borrower, you pay. So if you're paying 9%, who is benefiting? If you pay at 9% instead of 7%, who is benefiting?
Yes,
It's
yeah.
the bank.
Meaning
The bank. The
So
bank
it's
is
the banker
the
too.
bank is benefiting, yes.
So if it's the banker benefiting, then that banker must compensate.
Yeah.
That's what we said.
That
The
was
one who
good.
benefits must compensate. Okay? You'll be confused. Just understand, are you dealing with borrowing or investment? There it will sort out your confusion. If assume it's an investment. Assume it's an investment. And it's an investment is at 7%. Let's stick to 6. Let's stick to 6. Proper guidance. Because here in the question they gave you 7% and 6%. It's you to know which one is correct. Which one are you going to use? If you're dealing with borrowing, as I said, you say that me as a borrower, I don't want the rate to go above this. Because the more the rate, the more you're going to pay. The more you're going to pay, your interest cost will increase. So you try to mitigate by setting a limit that the rate should not go above this to protect yourself. But if you are an investor, you protect yourself by negotiating at a lower rate. You say that the rate should not go below this. Because if it goes below that figure, let's say it goes below this 6%, you will lose as an investor. you will lose as an investor. So you protect yourself by negotiating a certain rate, like 6%. Now, in a situation where it is 6%, who is benefiting in this transaction? And assume the rate is 9. Assume the rate is now 9. Okay, let's increase by 2 and it is 8. Assume the rate is now 8. Who is benefiting? Nancy, you're the one
The
who are
investor.
the
The investor. The investor, because now the rate has gone higher than what they agreed. So meaning the investor is going to compensate.
Here it's an investor benefiting. Remember, every time there is an increase on your return, if the return on investment has increased, then you as an investor, you benefit. So because you're the one benefiting, you must compensate. Are we together?
Yes.
But don't cram, eh?
No, I get it. It was a bit confusing.
When you cram these things, at the time, sometimes things can just go.
They evaporate.
Becomes hard for you. So here we are saying it's the banker compensating. So it will be compensation from the bank. And the bank is compensating how much? It's compensating, you get 9% minus it's the banker compensating because it's the one gaining, the one gaining in this transaction. In a situation where it's a payment, it means that it's the one gaining. So it's 9% minus 7% times 3 million, and times 3 out of 12. Others are quiet. I don't know whether we are together. That are quiet. When you're quiet, I assume. Okay, so finally, so are you adding or you're subtracting? Remember, here it's a payment. It's a payment. This one you put it. It's a payment, so it depends on how you want to record. It depends on how you want to record. If you want to record it in negatives, you can record it in negative. But if you understand what you're doing, then if you get what you are actually supposed to pay, you reduce the compensation from banker, you remain with net interest. Here, how much do you get?
67,500.
67,500. This is the actual interest cost. This is what you're supposed to pay. But out of this, the bank has compensated some money. So you can put the compensation in bracket.
Which is 15,000.
15,000.
15,000. Okay. So finally, what will be the answer? This?
5,500.
This plus this.
The actual interest is wrong. You've written it wrongly.
Net interest cost. How much? What is the correct figure?
67,500.
It is 60?
67,500.
Okay. All right. So that is our net interest cost. Then the effective interest rate is equal to, you get this net interest, you divide by the loan amount, which is 3 million, then times what? Times the reciprocal of what you have, 12 out of 3. Mm. Mm-hmm. Okay. Okay. Do you get 7%? That's what you have? Those with the calculator, do you get 7%?
Yes, we have 7%.
This figure of 3 million times the 12 out of 3. Okay, so we do the same, assuming a fluctuation of, assuming there is a decrease now, fluctuation of CBR downwards by 2%. From the current rate, which is 7%, to now it will be what? From 7% at what? If you decrease, if you reduce 7% by 2, you get
5%.
So finally you will say the actual interest cost. The actual interest cost it will be the 5% times the 3 million times 3 out of 12. Okay. Then who is compensating now? Who is compensating?
The investor.
It's not the investor, the borrower. The borrower is the one now. Don't mix those two. Eh? You had agreed that the rate to be 7. That is FRA rate. You had agreed that you as a borrower you should pay at 7%. You get? You had agreed with the banker that you should pay at 7%. Now the rate is 5%. Who is benefiting? Since you're the one to pay 5%, mean that you benefit as a borrower. You're paying at a lower rate. You're the one benefiting, so you compensate. And as you compensate, it means that now you're making a payment. You're making a payment because it's you the borrower, payment to the bank. You the borrower, you are paying to the bank. Okay. So you benefiting. So you get this 7% minus 5% times 3 million. I can tell you when you try to cram these things, they become very hard. They become very hard and you end up losing. In an exam, you can be very hard. There are some things you can cram. Here it's 2% times 3 million times 3 out of 12. Now it's a payment to the bank. So it means that it is going to increase. It is going to increase the cost. Already you're supposed to pay this, and still you're going to make a payment of this to the bank. So this figure must increase. You add here. You get this plus this. These things must be the same. If you find that you have different things, then you'll be wrong. You mark yourself wrong. Okay, so I believe you have mastered how we handle the forward rate, agreements.